Hello, everybody. Should be should be good. Good way to kick off this Friday webinar. Welcome to episode 3 of the Cash Flow Queries webinar series. Let's just start with sharing the screen. Things wrong. All right. It's Maybe it is some. All right, so let's go ahead and get started. Today's dialogue is going to be around cash flow complications. And so I'm Twyla, and we have a accounting firm in Calgary called 2080 Financial. We've had our firm here for 5-ish years. I know, we really should look at our LinkedIn. We've had our accounting firm for about 5 years, and in our firm we do all the way from bookkeeping straight through to sample advisory services. And so we do a lot of cash flow forecasting for our clients. And hang on, guys. This will be better. I bet you can hear us better now, right?
No, now.
No?
Now.
What now?
Yeah,
okay.
yay!
All right, we did it. On a Friday, we did it. Thanks, guys, for the heads up.
Now it's time for beer.
And you're dismissed. I love the flow of praise. Thank you for the praise and doing something that my daughter could have probably done in seconds. All right, now I can't even get it back.
Technology is hard.
It is hard sometimes. Now I can't get my screen back. Let's do this. Oh, Zoom, I love you. Are you laughing at my?
No.
Okay, guys, thanks for your patience.
I would never
Goodness.
laugh at you.
All right, it's as if we're starting at 12. It's only been 3 minutes. 3 minutes of complications. Sorry, guys. Okay. Let's go back to,
Uh-oh.
Okay. Okay, I'm gonna let you guys talk on there. Let's go back. Okay, we're good. Goodness. Like we've never done this before. You think it was episode 1, not episode 3. All right.
By episode 30, we'll have it down.
Yeah,
No
really.
problem.
Stick with us. All right. So we've developed a series of webinars really to talk all things cash flow, because we've spent the past 5 years really diving deep into a lot of cash flow issues for our clients. And ultimately, at the end of the day, we're just wanting to share our experience with all of you to give you kind of what we've learned over the course of 5 years doing this as a service, selling it as a service for our clients. So we started this series in firstly talking about what cash flow even is, so where to start, different types of cash flow, etc. Then we moved into just general cash flow conversations, so conversations that were before you started to engage in cash flow services, during that process, and after. And now today is about cash flow complications, because as we've been talking to the accounting community more and more, we get a lot of different scenarios thrown at us as to how to account for certain complications when you're building out your cash flow forecast. So that's what we're going to dive into today. I want to suggest that everybody please use the question and answer. We will have a time at the end for some question and answer. So please go ahead and use that. Maybe throw that into the Q&A rather than the chat, just so that we know that chat will be for if you aren't hearing us anymore, and Q&A, we'll touch on that at the end.
Or if my head's too shiny and it's blinding people.
And it's making it awkward. Yeah. Okay. Put on your sunglasses, folks.
Yeah.
Anything else you want to add there before we jump in?
No, I don't think so. I think this series, as you said, this specific one is for complications, but this series in general, I think is super valuable to people, because as we've talked to more people, even on the Zero Road shows and QuickBook Connect shows, a big miss so far in the industry, we believe, is the how-to side of things. So, it's not just in cash flow, but it's across the board. There's lots of apps out there that are nice and shiny and do lots of cool stuff, but how do you actually use them? And so, we're not selling our app here at all. This is a total different event that we're doing this afternoon. I just wore one shirt. I'm lazy and a guy. But generally speaking, we want to help teach people how to actually do stuff. And so give back to the community, so to speak.
Yep, absolutely. Sorry, we got emergency outside. All right, so let's go ahead then and dig right into some of the complications that we've experienced or we've had other people approach us about. So first one is actually the most simplistic of the complications, and Kelvin and I were having some dialogue around this morning as to why this is considered a cash flow complication. And often what I hear people saying is, I don't know how to do a cash flow forecast for my clients because they're on a cash base for their revenue. So there's no prediction in terms of what's coming in. It's basically what they collect that day is what they collect that day. And if you've kind of watched any of our episodes in the past, you'll know that even though we've got one firm combined here, we just naturally have a bit of a segregation of the types of clients that Kelvin and I tend to take the lead on. And from my side, a lot of the clients that we do this cash flow forecasting for are cash bases when it comes to how much is coming in. They never have AR. So one of our biggest clients that we do cash flow forecasting for is a fitness franchise. They have 9 locations across Canada, and what they have coming in is what they have coming in. And in their case, even when you think about a fitness franchise, you could start to think of a monthly subscription model or a monthly membership model. And although they have that, this type of facility also has drop-ins. They have punch pass cards that you can buy. There's no guaranteed amount of revenue that they're going to make in each month, which means that there's no guaranteed amount of money that's going to get dropped into their bank account every single day. So this applies with a fitness franchise. It applies with retail. If you're doing forecasting for a restaurant or a hotel or
anybody with a point of sale system.
Yeah, anything with point of sale, even professional services. I mean, one of our clients that we've spoken of in the past is a vet clinic. Even he obviously knows what's on the calendar for appointments coming up, but there's no guarantee in terms of what's coming in, and it can definitely fluctuate from day to day as to how much money is going to be deposited into their account. And one thing that I just wanted to share is that kind of had a light bulb moment in terms of describing cash flow forecasting when I was working with a bookkeeper over the last few weeks, just kind of going through some steps in terms of how to start to do cash flow forecasting in her bookkeeping business. And basically what we outlined to her is that when you're doing, let's say you're doing a 90-day cash flow forecast, essentially what you're doing when we're talking about a direct method, as we're using here, is you're essentially pretending like you're building out 3 months worth of bank statements. So day by day, what are the ins and outs of that business? And you're going to see, a month-end balance and the next 3 bank statements. You're going to see a running total as you go through each month. But essentially that's what you're doing when you're talking about a granular direct cash flow forecast, which is what we mainly do for cash flow forecasting, is you're essentially drawing line by line. No matter what tool you're using, you're wanting to draw line by line. What are the ins and outs as they would appear in a bank statement? And so that's just something to kind of keep in mind, is that, it's not, we've said this before, is it's not actually complicated to do cash flow forecasting, especially if you just think of it in a way that really resonates with you. And that's been one that's stuck. Yeah. So when I do cash flow forecasting for clients who are, like, for example, the fitness franchise, essentially what I'm doing is forecasting. And like any forecast, there's a level of prediction and estimate that you're using when you're building out that forecast. So for example, if you use basic math, if they're expecting $40,000 in revenue this month, again, it's an estimate based on what they've been doing in the past and what we expect to see over the next 3-4 months in revenue. If it's $40,000 a month, you can do that in a number of ways. You can say, okay, we're going to collect that $40,000 at the end of the month, and as we work through the month, that number depletes. Or you can say every week. So for example, the one that I use is I do every week they get their money at the end of each week. So it's conservative. So if they got payroll coming out on the first of the week, that we're not, overestimating our incoming money, and that we're saying that money is available for payroll, because it's not yet. And then I've even played around with doing this by day. And by day, I mean by weekday. Because with point of sale systems, a lot of them, you only get that money deposited into your account on a business day. So I use business days. So I take the 40 grand, divide that out by however many business days there are in the month, and then put that out over each day. So you can kind of handle that a number of different ways. But essentially what you're just needing to do is forecast that revenue. And it's ultimately talking to your client. What are they expecting to see dropped into their account over the next, say, 3 months, or however far out you're looking? What are they expecting based on trends, where they're at in their business, seasonality, etc.?
Yep. No, and I think talking about it as a bank statement is the best way to put it, because the complication in this sense is, well, I'm trying to create a bank statement, but I actually don't know the days that any of my revenue is going to hit. And not only that, I actually don't know what the revenue is going to be.
Yeah.
So what you're saying is estimate it based off the past.
Mm-hmm.
And, it doesn't apply in just cash base. It applies for every single business, I think. There's very few businesses, as we discussed this morning, that actually have contractual guaranteed revenue.
Mm-hmm.
And so at some point, you literally just have to look back into the past as your gauge for the future. And what we were saying also this morning is it's a very good opportunity to talk to your client. And we're wholehearted believers in that, cash flow forecasting in of itself isn't probably rocket science, but the magic that it brings to the table is, you as a bookkeeper or an accountant, it allows you to dialogue with your client a lot more frequently about something that they wholeheartedly understand, which is the cash in their till. They're worried about it every single day. And it allows you to showcase your value and your expertise to your client, and start creating a sense of loyalty and relationship, at which point the client tends to start opening up to you about other things, which then helps the forecast. So it's creating that value and relationship-based service, and it has compounding effects. So, in estimating out a very simple forecast, by day, by week, by month, however you determine is the best way, it provides you that first initial discussion point with the client, which then they might have input, which then actually changes the forecast and makes it more accurate, because maybe your estimate was not exactly what they believe. Maybe revenue for the next month is 10% lower. And they have insights as to why that might be. Maybe it might be weather related. Maybe it's just demand's low. Maybe they just changed, a new location.
Mm-hmm.
It could be any
So
number
many
of things, right? And
yeah.
that's where you go back to, like, everything here still ties back to the relationship with the client and the dialogue and the back and forth. It's super important in this whole gamut of what we're trying to do.
Yeah, exactly. One other thing that actually just dawned on me when I was thinking about, we were just recently in Vancouver and having some discussion with somebody who said, yeah, well, when I go to my client and ask them about revenue, I know that my client always gives me this pie in the sky number.
Yeah.
And so, that's an opportunity to say, use your intel in terms of, you've got the historical data.
Yep.
So maybe they're expecting it's going to be 60 grand this month, but month over month, it's always been 40 grand. Perhaps they do know something that you don't know in terms of advertising or adding another location or something. But if you get to know your clients, and your client could be the one who's always thinking, oh, I'm definitely going to be at 60 this month, when you know darn well they're probably going to be close to 40 again. You can build out even more than one cash flow forecast that says, if you are 60, sure, then go ahead, this is what it's going to look like. But if you're 40, which is more like what I'm predicting, which is more conservative, then here's what it's going to look like. So again, with any forecasting, you're really just using the best information that you've got, which is your historicals plus your client intel and that client dialogue, to build out your best guess as to what it's going to look like. And the more you get to know your client, the more you can refine it and fine tune it to being a little bit more granular and a little bit more accurate.
And I think that's a really good point, because, even going back to our old Excel models, it took forever to build them out. And once you kind of had them in a spot where you thought you were comfortable, through dialogue and refinement and time, something would always change, and you'd have to change the model a little bit.
Yeah.
And so things are continually changing, but the reality is the more you get to know your client, the more you're just tweaking it, as opposed to these big whole scale changes. And the more iterative that becomes, and the more time you do it, the less time it takes.
Yep, for sure. Okay, let's move on to the next point. So, flip side of the cash basis is doing cash flow forecasting for clients who are on an accrual basis. So their accounting's all done on an accrual basis. And we just wanted to talk through a few examples here because this is a question that we do get asked when somebody's setting up a cash flow forecast is how do we account for things like prepaids, unearned revenue, deposits or retainers? Maybe if you want to kick off.
Yeah, well, and I think it's an interesting case too, because when we're talking accruals here, as we were saying this morning, people can use kind of a mixture of cash plus accrual. It's really quite common, despite what people think. For normal everyday managerial accountants and bookkeepers, you kind of go with what's easiest for the process. So a prime example would be prepaid expenses. So insurance expense, it might be $6,000 one-time payment, but you might actually be recording that as a $500 charge on your profit and loss statement every single month. So the reason that becomes a complication would essentially be because if you're looking at your profit and loss statement for your future looking information, that's essentially establishing your budget. And so your budget would then say, well, budget $500 of spend every single month into the future for your cash flow forecast. But the reality is that you're actually only spending that amount of money one time per year, and it's actually 12 times the amount. So it's more a complication in the sense that you have to be cognizant of these items and how you're actually using them in your forecasting. So, if you're using an Excel model, perfect example, because you probably pull out through QBO or Xero or whatever accounting system you use, you download your profit and loss. Maybe it's an annual one, you divide by 12. That's your future looking information, your future looking estimate, as we were just describing, even for revenue. But you have to be really cognizant of some of those items like, insurance, legal fees, because you could have some retainers and other charges like that. But items that really only happen one time, but are spread over many, many months.
Once a year.
Yeah, exactly. So it's becoming really cognizant of that amount. Another one that we've got listed is unearned revenue. And so it's a little bit different in the sense that essentially you're getting paid upfront for services that actually haven't occurred yet. So on a cash basis, you would simply get paid when you get paid, and it is what it is. Whereas some people that are separating those out, you'll actually collect money up front, do the service afterwards, and then it becomes revenue at that point. And so that creates a little bit of a complication in the sense that you've already received the money and it's already in hand. And so that can then again create complications when you're starting to look out into the future, because if you're kind of double counting the revenue, so to speak, it actually won't be there. And so your cash flow will in the future be lower than what it actually should be, because you've already collected the money up front and aren't actually going to earn it.
Yeah, I think that's a great one, because essentially if you go back to the idea of it being a bank statement, you are wanting your cash flow forecast to be representative of the money that's going to come in the bank. So if you've got $10,000 that you already collected on a $50,000 invoice that's going to be going out the door next month, you're not going to collect another 50. You're only going to collect 40. So when you think about your bank statement, you already got the 10. You're only collecting the 40. So it's just watching that when you're using things like prepayments, or your clients collecting retainers or something of that nature, to make sure you aren't overestimating how much cash is still going to come in the door.
Yeah, and I think the magic thing here in terms of going back to the whole how-to. There's no magic, I guess, to really how the how-to is outside of going back to your expertise and knowing the business and the ins and the outs, and knowing, if you're doing accrual accounting, you obviously know why you're doing it. And so just making sure you're kind of going through and checking your numbers when you go through the process. And so usually it's probably more on a setup process, I would think. So when you're actually setting up your spreadsheet or your new app, whatever you're using for your cash flow forecasting, it's just being cognizant and aware of some of these accrual items that might hop out at you, like prepaids and unearned revenue.
Yeah, exactly. I mean, when I've built out cash flow forecasts on Excel in the past, I definitely do use the P&L as one of my starting points. I use my AR, my AP, and then work through my P&L. But essentially, again, you got to remember that you're building it out as if it's your bank statement, not your P&L. And there's things that are on your balance sheet that still go through your bank account. And a very obvious one in that we all can relate to is when your business owner takes a draw. That doesn't show up on your P&L, but you still see that money coming out of the bank every single time that owner pulls a draw. And so similar kind of concept in terms of these things hang out on your balance sheet. They may or may not need to be recorded in your cash flow, but a lot of times when you're talking about something that's going to affect future money going in or out, like a prepaid or like a deposit on account or like insurance, setting that up as kind of spreading that over the course of the year, then you need to be mindful of over or underestimating your inflows or outflows in the future because of the things that are hanging out on your balance sheet.
Yep. And I think a good point there, it's maybe not accrual related, but we didn't make a point about it. One that I found that catches people a lot is tax payments. And so,
GST,
it'll be showing up as a liability on your balance sheet because you're accruing that expense over time. So I guess it is technically accrual.
Yeah, exactly.
Answered my own question.
It could even be an arrears payment though, right? Because I had that question saying that somebody was behind on their income tax and that they've now got an arrangement with the government to pay it off over X number of months. And so they have a payment that goes towards it. So that money comes out of your bank account every month, does not show up on the P&L anymore. This is from last year.
Sales tax in Canada would be a prime example. We have GST, specifically here in Alberta, PST in other provinces. Won't get too far into that, obviously. But the reality is that you're collecting GST the entire time, and you're either going to have to pay or collect from the government in the future. And that can happen quarterly or annually. And we've always found in the past that with our clients that are on the annual plan, that's always an issue because they always forget about the GST because it's not on the profit and loss statement, and it's 5% of every single sale that they always make. So it can add up to be quite a bit. But again, the complication then ties back to understanding the company, understanding the accounting and the bookkeeping aspect of it. You guys are the experts on that regard. So again, being cognizant of these amounts so that when you're actually working through and planning, we here in Canada would have to be cognizant of GST and the planning and the cycle of that particular client and saying, look, this client is on an annual basis. So, we're sitting here in October. So 3 months from now, 2.5 months from now, we should expect to pay a very large amount of money to the government. And so we need to add that into our forecast as well.
Yeah, for sure. No, good point. Okay. Next one. So
I think you skipped.
Did I skip one again?
One ahead.
Why does it do that? There we go. I'm just shouldn't be touching computers.
You're shifty. You're shifty today.
Yeah, magnetic. This is a trend. Okay, so let's talk. This is somewhat related, but let's talk a little bit about progress payments because that's something that we do have clients or people talking to us when they've got clients who are, say, in a construction industry or engineering or even architecture, something like that, where there's progress payments towards the end of a project that'll be billed in the future.
Yeah, and again, it's not a complication in the sense that it's not hard to work around. The prime example would be is you're a construction company, you build out $100,000 for a potential project, and you can only bill that out when, say it's 4 progression payments and they're tied to the actual construction process. So when 25% of the work is done, you can bill 25%. And then when 50% is done, you can bill the next 25, so on and so forth. And so the reason that we're bringing it up is every single conference and show that we go to, it's one of the primary questions that everybody has is, how do you handle it and can you handle it? And it's a very common ask for people. So it's obviously very prevalent out there in the accounting world. And so again, it's being very cognizant of how your client is set up and how they progress draw essentially and how they invoice and how that process works so that then you can actually map it out accurately on the cash flow forecast. And again, I think that goes back to the process isn't complicated because using that $100,000 example, it's okay, well, when do you expect the first 25% hit? It's not going to be perfect with their best guess. You can also create scenarios based off, best case, worst case, expected case. And you can do that for every single phase. And, keeping in mind that some people will be super tight and the more accurate you are, the better. But you do have to deal with the information that you have, and best guesses are usually what happens, unfortunately. And so that's part of going back to what I was getting at, which is dialoguing with the client. And, continually being involved with them. This is much more of an operational tool than it is anything else. And so I always go back to, it's managerial accounting as opposed to compliance and this, that, the other.
Mm-hmm.
And so if you're not used to the managerial side of accounting, it is different in that sense. And it does create more dialogue or require more dialogue and more back and forth with your client.
Mm-hmm.
Which is totally fine and totally good. And the client typically really likes that.
Mm-hmm.
And often what you find, again, is that you can pull out information for some of the compliance side of things, or tax advice, or this, that, the other. But again, the complication here being that, you've got a little bit more of a complex invoicing and billing system. You need to talk to your client about that, initially set up what you think is going to be the expected case, talk with your client, figure out the tweaks that you may or may not need to do, and then revisit it. If it's a multi-month contract, if you're talking to your client every single week and saying, hey, this project that we set up, how far are you? Are we pushed back a week, or are we pushed forward a week? What does that look like? You can easily tweak your forecast once you've got it all set up, which goes back to what I said. Once you set it up, the tweaking is much, much easier.
Yeah, for sure. And I think, with anytime that we get approached about a question of how do you cash flow forecast for this, truthfully, the immediate answer is, well, that depends, because it depends on what you're doing in your accounting system so far. Because in this exact example, I had somebody last week say, how do you account for progress payments on a project? And it was a construction company. And I said, that depends. How are you recording it in this case, it was in QBO. And she said, well, taking that example of $100,000, they only bill the $25,000 when it's time to collect the $25,000. So it's not the other case that you're explaining, where it's like you're billing $100,000 and collecting $25,000 increments. This was like they aren't actually recording any revenue until they get to the point that the job is 25% complete, and then they're billing 25% of the overall project. So that's a very different scenario than if you're billing $100,000 but only collecting $25,000 increments throughout the period of time that the project is ongoing. So in all of these cases, I always kind of start with it depends. How are you recording it in your accounting system? And then what information, again, going back to the client communication, what information, tell me a little bit more about your client and their industry and kind of some of their complexities or their idiosyncrasies. And so that's where with kind of our role, as helping the community, is we want to be able to help and help you set up a cash flow scenario that makes sense and it is accurate. Very importantly, that it's accurate in terms of, you're going to give advice off of this and you're going to dictate when to release payments off of this information. And so we want to help you get that accurate. And I lost my train of thought on one other thing I was going to share there. Helping to get it accurate. And I know what it was, is that sometimes what I've had people say is, I'm just going to remember in my head that there's also another $25,000 coming or something to that respect. It's like, well, let's help you not have to remember that, because I know for me, especially in the accounting business, that I constantly have things like that tucked in the back of my mind, and it keeps me up at night because I'm thinking I can't forget about that $25,000 that's coming in a couple of weeks, or they have to pay even different. They have to pay in a couple of weeks. And the only place I've got it tucked in is the back of my mind, and it's not being reflected in the documentation and in the forecast that I'm doing for the client.
Mm-hmm.
So
yep.
We want you to not have to do that. Don't do what Twyla does. Do as I say, not as I do. Okay, so next one is seasonality. This is really a case with a lot of clients, is that there's something that affects timing and amount of the revenue that they have. So maybe I'll let you kick this off with kind of what your clients, your seasonal clients experience.
Being here in Calgary, we've got a lot of energy services firms, oil and gas related type firms. And so, there's two kind of seasonalities, actually. There's weather related issues. And so to get into it a little bit there, you can't actually drill a well when the ground is too muddy. Essentially, trucks can't travel, they get stuck. And so there's road bans. And so what that creates is very, very, very big highs and lows. And, so wintertime is very high because the ground's frozen, then the ground thaws. So no work actually happens and the companies basically stop drilling. And then in the summer, the ground is hard again and you can start drilling again. And so you get these very, very big highs and lows. And so that's over the course of a year. So you essentially have annual or monthly, I guess you would call it, seasonality, where January, February, March are very much higher than April, May, June, so on and so forth. You get these nice little cycles. And so the complication there is, how do you actually manage that in a cash flow forecast? And especially when you compound it with accrual items, where in January you're billing very, very large amounts, but you're probably getting paid 90 days later. So your January revenue is actually coming in April-ish, give or take. It creates a very big complication, because for the business, you're paying your employees and your rent and your fuel, in this particular case, all up front. There's no term on that. It's all out of pocket, but you're actually not getting paid till 4 months later. And so the way that I handle that is I do it very similar to what you were talking about with the fitness franchises, which is I create a base level forecast for every single month. So it's essentially the low point of the year. I create that for every single month. And then for the high points, I go back and say, okay, in January, February, March, I expect this company, based off last year revenue, again, going back to, I don't know when they actually, or if they will actually be earning that revenue, but based off last year's numbers, I would expect them to make the same, unless they tell me otherwise. And I simply add that revenue into those months. So January, instead of being $100,000, might be $200,000. And February might be the same. And then maybe March goes down slightly. Then what I have to do is, because that's only when the revenue is earned, I then have to add term to it. And so then I have to push the actual cash component back 90 days. And so essentially I create that base model forecast. I add what my seasonal peaks are going to be, where they're supposed to be. So in this case, winter and summer. And then I add the term onto it, and that gives me the actual cash inflows for the revenue. The expenses are very much, like you said, essentially cash basis. 60, 80% of most businesses are
people
and rent is the 80% of most expenses, and those are typically paid on demand. So those happen when they happen. And so that's how I handle that. But interestingly enough, as we were discussing this morning, you can actually have even seasonality within a month. And so you could have it so that even within these gyrations over month, you can actually have them essentially week over week. So, the first week of a month could actually be higher or lower than the second week, third week, fourth week. I personally would handle that the same way, where I would create a base level forecast and then add my highs to where they need to be based off my belief of where the seasonality is going to hit. And some of that essentially requires analysis of your past numbers. So, you're going to have to create a month, like say my example of the year, where you've got January, February are higher than April, May, June. I would actually have to create a month over month profit and loss statement and actually pinpoint that, essentially average it out, take the last 2 or 3 years and take the average amount of each January and each February and each March, and compare it to the low point, and then essentially start creating differentials off that. So if June's my low point, let's call that 100%, and then January's 200% higher than that, then that's what I forecast. So that's how personally I would handle that.
And I think this comes back to, again, knowing your client and having that dialogue with your client. So you've got historical information in a lot of cases. In some cases, though, they're brand new client, and you want the opportunity to get to know the seasonality or the trends within that client. So, as you've been talking, I've been sitting here thinking, which industries wouldn't have much or any seasonality? And I'm sure that there's some, but I think a lot of them have it, whether it's retail with Christmas, or it's travel industry that's obviously got high peaks and low seasons and shoulder seasons. And, there's so many industries where there's some level of seasonality or trending that happens. And this, I do think, is, again, another opportunity to understand the industry and understand when the highs and lows are expected according to your client. And in amongst that, it's, let's use retail as an example, because I think everybody can relate to the fact that from November through to December, if you're somebody who's in retail, that you're expecting to have higher sales in those few months due to Christmas. And so there's the idea of, if you've projected $200,000 in sales in November and they don't reach that, does it mean that you'll collect that now in December, or is it lost revenue that we were overestimating that? So there's a lot of things that can kind of go into the seasonality of the business, whether it's related to weather, holidays,
even pricing, which is not seasonal, but like commodity pricing can have effects on people.
For sure. I mean, the fitness industry, obviously high time for them is January because everyone's got New Year's resolutions. Their low time here in Canada is in the summertime because everybody wants to be outside. They don't want to be inside of a fitness facility. There's all these different kind of trends and patterns that happen. And typically you do want to include that in your cash flow forecast to some degree, and how much degree depends on how much they're impacted by those different things. But it's something that we take into consideration for all of our clients. Even a vet clinic, he's got high months and low months, even though you'd think that vet or pet care is ongoing all throughout the year, there still is high and low months. I mean, nobody wants to do it right around Christmas because they got family in town or whatever.
It's surprisingly seasonal,
actually. Yeah, there's a lot of seasonality even with something like a vet clinic that you would think would be super consistent because it's your pets and immunizations and surgeries and whatnot.
Yeah. Well, and I think the main point from my perspective on this topic is don't be afraid to look at your past data, because your past data tells you a lot about what probably will happen into the future. So if you said your client's not growing, last year's numbers will probably accurately reflect this year's numbers. And if there's seasonality, it will show up in last year's numbers if you're taking a month by month analysis as a comparison. And so then it would be simply a case of, is the company growing or declining? And, hopefully most people are growing. So maybe you take last year's numbers and add 5%. But I guess my main point is that a lot of people have asked us, where do I even start? And I think your starting point, if your client is open to it, having that dialogue, that's great and perfect. But as you say, most entrepreneurs are a little bit optimistic, and maybe that's not the best place to start. I think I'm kind of speaking for you right now. But I tend to believe that we usually base most of our future looking forecasts off of the last year's worth of data, because it's still very close, so to speak, timing wise, which makes it more relevant, or as relevant as possibly can be. And we use that as the starting point. And then quite often we use dialogue with our client and kind of information that we've gleaned from that to then tweak the forecast up or down based off those conversations.
Yep, no, for sure. All right, so I know you love talking about this one. This is cash flow forecasting for clients who have lines of credit.
I love lines of credit.
Well, you just have a more complex cash flow forecasting situation with a line of credit that's not a standard line of credit. So.
Yes, I do.
That was your segue.
in this particular situation that we're talking about, obviously we have multiple clients with lines of credit. But the one that Twyla's talking about is I have a client that has a variable line of credit. So it's not just dealing with cash flow and kind of dipping into a line of credit. The reserve, so to speak, the line of credit itself actually changes month over month based off of accounts receivable. So there's lots of line of credits that are variable in nature. They are often tied to accounts receivable or inventory. I've heard them being tied to sales and other numbers, which I find interesting. But the point being is that there's multiple different lines of credit out there that have variable natures to them. And so the complication here is that because it's changing over time, it actually changes the amount of money available to the client in the future. So again, it's not rocket science per se. It's more a question of sitting down, understanding how your line of credit works. So in this particular case, it is based off accounts receivable. So moving forward, I actually have to estimate sales and the accounts receivable I actually expect to have in the future. So going back to what we were just talking about, we estimate our future sales based off past. So that's the easy part. Calculating the accounts receivable is a little bit more difficult because you have to then make assumptions on how much of that revenue is actually going to be collected. How I do that, I use our app now. Shameless plug there, I think. But the reality is when we were using Excel, I would actually have to manually do that information. And so what I would do is I would take an average of how people were paying the company in the past, which we knew on average that people were paying essentially around 90 days. And so we would simply add that as a very bulk number in the future, and essentially calculate our sales, add that to the accounts receivable, deduct what we expected people to be paying us, and then using that for our accounts receivable amount. And then we would have to calculate the line of credit based off of that amount, and we would have to do that every single month. So you can see how complicated it can get very quickly. The concept itself is actually very simple, but it is complicated in the sense that it's very dynamic. And that's the hard part with variable lines of credit is really ensuring that you're on top of the numbers and having very, I would say, consistent theory behind it, because as soon as you start changing your logic behind it, it changes how you're calculating, which then changes your forecast quite rapidly. It's definitely a tricky area of cash flow forecasting because it's basically throwing another very complicated variable that changes multiple times in the future with something that's highly variable itself.
Yeah.
Inventory lines of credit would be handled the same way. You'd have to figure out some way to estimate how much inventory you're going to have on hand, which is going to come down to sales versus cost of goods sold estimates, and how you believe you're going to push inventory in. So your purchases versus your sales and what that looks like. So again, conceptually, it's the ins versus the outs on the variable item before you even get to the cash component. So yeah, it gets a little bit of dicey on that.
And you know, it's kind of funny because we started with the most complicated, line of credit, because of course there is the line of credit that it's
the easy one,
set $50,000, and that's what the line of credit is. And that's more straightforward, because then you just know when you're building out your cash flow that you've got up to $50,000. Like, you don't have to be concerned when it goes to zero. You got to be concerned when it goes to -50. That said, this is another opportunity to get to know your client, because we have a client who that line of credit is her security blanket. That's emergency. And when they dip into that, for her, it's like, oh my goodness, what's happening with my business? And
we're failing.
Yeah, exactly. And so definitely get to know your client, because if your client gets anxious as soon as they dip into their line of credit, they're probably not going to love you building out their cash flow forecast around a line of credit and going consistently into that line of credit. Instead, you almost can pretend that line of credit doesn't exist and know that it's there as a backup and it's a security blanket for the owner's kind of mental health, to be honest. And that you're trying to build out the forecast that if it's going to look like it goes into below zero for whatever reason, what actions can you take ahead of time in order to prevent that from happening? So as we always say, we find that in most cases, it's not necessarily a cash shortfall. It's often a cash gap, which means that they're paying vendors too fast and collecting too slow, and the timing just doesn't work at work. And this is most relatable in our own businesses as accountants and bookkeepers, where if you've got rent or you're paying people, that you're paying them on time, like you said with your client, it's payroll, it gets paid on time, but maybe you're billing at the end of the month instead of the beginning of the month, or maybe you're billing at the end of the month and then still giving them terms for the next 30 days. So now you're 60 days behind.
This sounds like a value pricing conversation.
We'll talk about pricing in an upcoming episode, but it's the reason I bring it up is it's so relatable to all of us that we know in our own businesses what that looks like. And so that same information applies to your client. Are they collecting too slow and paying too fast? And can you keep them out of their line of credit by giving them some advice where it's like, okay, look, I get it that you don't like to be in your line of credit. Maybe that's the incentive to make that follow-up call and call your clients who've got some AR sitting outstanding. Or maybe that's the incentive to change up your workflow entirely, where now you're billing flat fee, or you're pulling out the monthly fee on a pad agreement or on the credit card automatically each month, whatever that is.
Or maybe it's incentive to go or get more sales, or potentially have very hard conversations about maybe there's not the opportunity to get sales, and maybe it is a structural cost issue, at which point maybe you need to assess cutting costs.
Yeah, some expenses, exactly.
For sure. And I think what you brought up is a very good point, because, lines of credit are typically there for buffers, for the seasonal highs and lows, which we were discussing on the previous slide, or previous two slides. And so it's a good conversation piece, even with your client, that, that particular client that you're talking about, there was a lot of dialogue around, this is what this line of credit is for, and it actually is okay to use it sometimes, because as we showed them with our forecast, you will be coming out of it and life will be okay. And so, so it is okay to use it sometimes, because that's what it's there for. And that to me, I think provided a lot of, using that exact situation, that provided a lot of loyalty from the client, because after they could see that they were coming out of it, it was almost an aha moment where it's like, oh, thank you for letting me know that
Yeah.
I'm actually okay.
That it's not a red flag
Yes.
that I need to be changing something in my business and panicking because I dipped into my line of
Well,
credit.
and making rash decisions,
Mhm.
right? Because people that are making decisions based off emotion as opposed to the actual hard numbers,
Mhm.
they're typically not the best decisions.
Yeah, exactly. Lines of credit certainly do have a purpose. I mean, we talked about seasonality, and it can definitely, I was giving the example to Kelvin before we started, is that my parents had a very seasonal business. They had greenhouses and a flower shop, and all of the supplies, everything, including starting to pay staff, all had to be done before the actual season of sales began. And that's, believe me, my mom is so good with their money. That's the only time she would ever let it go into a line of credit, is that she knew that if that she needed to buy uh, those supplies up front, that she had to use that line of credit and feel comfortable that within the first month of operations or whatever, that they were able to pay that off again. So.
Yeah.
It definitely serves a purpose, but know your client, know what it's there for. Is it there to cover things like highs and lows in terms of seasonality, where they know they're going to get out the other side of it and it's going to be fine when you look at the big picture?
Yep.
Or is it the security blanket? Or is it something that's tied to accounts receivable that's going to fluctuate? You need to be prepped for that, etc.
Mm-hmm.
Perfect. I think that's all the real examples that we had that we've got on the slides, but we've got a little bit of time left, so I just want to touch on a couple of other complications that we were chatting about this morning that we'll throw in here before. It looks like we've got one question that we'll answer, and then if anyone else has any questions, please throw them in the Q&A. Even if it's something we haven't talked about that you think, hey, I'm going to throw you this curveball and give us a complication, feel free to shoot that in the Q&A now. Let's talk about these couple of other ideas.
Before you do that,
Yep.
I'd also like to say, even on some of the, say, variable line of credits, like if, going back to the how-to and us wanting to kind of help people out, like if people actually want to see a hard, concrete example of that, shoot us a note and let us know, and we can create a obviously generic and anonymized version of it. But again, those calculations are easy. It's just it's hard to describe and easier to show on a spreadsheet.
Yeah, totally. And I think that's something that's always good to throw in here, and I don't think we touched on the start. If you don't know us, this is your first time ever talking or listening to us, know that we are open books, and we've said this time and time again, that
we're givers,
that there's nothing in our practice or nothing that we do with the client that we would not be willing to share with every single one of you. And so if there's something that you want to be able to see out of something that we've described today or in other episodes, by all means reach out. Obviously we'll anonymize it for the sake of our clients' privacy, but the data will be there, and we can definitely share how we've done it in Excel in the past, how we've used the tools that we've got now to do the forecasting, whatever that is. The other thing I want to throw in before I forget that I meant to say at the beginning is, if you missed episode 1 and 2, these do layer a little bit, but they are available. So shoot me an email if you've got, if you're wanting to see 1 and 2 and you missed them, and I'll be sure to get that information back to you. This recording will also come back to you for future reference, but yeah, if you're wanting 1 and 2, let us know. Okay, let's talk about these couple of things here. Well, I know what the question is. It's sitting in there, and it won't take much time. So
you sound confident.
Oh, I read it already. Yeah, let's start with bad debts.
Bad debts.
Yeah,
it's my favorite because I hate
or
them.
not favorite. Yeah.
Not favorite.
Favorite, unfavorite.
Yeah, I mean, it's a complication in the sense that you've already recorded revenue on your books, so there's actually kind of, I guess there's only one thing. I was going to say 2, but it's really 1. You've essentially overestimated your revenue. And so, well, there is 2 things. You've overestimated your revenue. So in the past, at some point, you've recorded revenue that actually doesn't exist. So you need to be cognizant of not actually recording that revenue moving forward. So you essentially need to turn that customer off, just take them totally out of your future forecasts. But not only that, now you've actually got an amount of AR on your books that you maybe actually want to leave in accounts receivable because you actually want the client to chase them and continually talk to them, hound them, do whatever your process is to try and collect. But the reality is you don't want to forecast receiving that cash. So not only do you have to kind of adjust your future looking information, but you actually also have to adjust your accounts receivable balance. So again, it's not hard. It's just one of those things that, if you're talking to your client, it is a good question to ask. If you've got 50 accounts receivable customers, 50 customers with accounts receivable, I should say, how many of them are actually assured to pay? and 9 times out of 10, they're going to say all of them.
Yeah.
But you just want to make sure that you're asking that question, because there is that one time that it could be a substantial amount. And if it's a substantial amount, it will affect future operations because you're not going to receive that money.
Yeah.
And you got to plan around it.
Yeah. And I won't deny that there's times that the client tells me something about something like that, and I don't set up my cash flow forecast that way, because I find that a lot of times clients think, yeah, I'm totally collecting that. I'll definitely collect it.
I'll get it in 20 days.
And they do a couple of things. They believe that they're going to collect it, and they keep doing work for that client. So if that client hasn't paid you from 6 months ago, like for the past 6 months, what's the chance that they're going to pay you for work going forward? And I always kind of use that in my mind. What are the chances of collecting this? And if you think about building out the cash flow forecast as a bank statement, if that money is not likely to come in, then it shouldn't be on your cash flow forecast, because it's not going to show up on your bank statement. And so I will, in cases, where you've got, again, you'll get to know your client when you got that client who's like, yeah, I'm totally going to collect that I'll call them tomorrow. I often
that
will
solves
say,
everything.
I'm not going to include that, because keep in mind that in our practice, it's not just about the cash flow forecasting, it's also about cash management. And so now I need to make decisions about what's getting paid when, based off of that cash flow forecast. And if I'm trusting the client to collect that and call on that client tomorrow, even if that client agrees to pay, they still have to trigger the payment. There's still some steps that have to take place. I don't want to make decisions off of that uncertainty. I want to make decisions off of what I feel most confident will actually occur when I'm building out the forecast. And so I will often ignore the client and disregard. I leave it on the AR. I just don't include it in the cash flow forecast and say that's bonus money if they collect that in the future.
Well, and I think it's actually what you just said. I think it's a very good opportunity to highlight what that work actually is worth, because you could show, here's your case without that customer paying you, but here's what it would be worth if that customer did. Not saying that the customer will, but more highlighting, if you probably got a different customer that did pay you on time, this is how much more would be in your bank account right now. And taking that step further and creating a different scenario, showing, the what if you actually had a good paying customer? Because what you just said is totally true. I mean, people typically go back and try to get more work because they like the person, or they're a big client, or there's numerous reasons. And it's bad revenue. Like we use that term a lot. It's bad revenue. And one of our jobs as advisors is to stop the bad revenue. And again, that's that emotional piece. Like the client, they feel it. They want to have that revenue number as high as they can, because that's what they believe is real, when the reality is it's actually the cash coming in after that. And so if it's bad revenue, our number one recommendation is to stop following it, but it's hard to do. So
it is hard for them to do, and there is so much emotion. But in terms of the actual cash flow forecasting, I can be unemotionally attached,
and you should be,
and determine what I actually think will come in. And you can look back through historical, even if you haven't worked with your client before, but they've got historical data, you can look back to see, has this been a pattern in the past? And it helps you predict what's going to happen in the future versus what the client tells you is going to happen in the future. So, okay, so that's good. I think let's touch on these couple of questions.
Pick the easy one. It's so easy.
It's so easy. Okay, we got a couple of things here. So first question is, with the granular Excel approach that starts with the bank balance, how do you suggest I build in the Visa charges? Actual line items from the Visa, or only lump sum payments to the Visa?
It depends.
This is a great question, because Kelvin and I handle this very differently. So I'll let you share yours first, and then I'll share what I do.
Well, I think for me, it depends, because my clients have lots of lines of credits. So they have the ability to push beyond zero. They can go negative, essentially, and still survive. It's not the best way to operate, but you can get away with it. And so the way that I handle it is I actually aggregate all of my bank accounts right from the starting point, and I essentially create one number. And then that way, every single transaction that runs through the accounting system is it is what it is. And it's kind of indifferent to the bank account that it's tied to. It's just simply a payment. And it's super easy to forecast that way. It makes it much more simplistic, much more easy to understand, depending on the client. But for my clients, it works and it makes sense. But I know that you do it very differently, and there's very good reasons for it.
Yeah, I mean, depending on the client, I can kind of sometimes do a combination of approaches. Just trying to think of best ways. So with some of the clients, what I do is I simply lump sum it. I say, when will they pay that balance of the visa off? Or in some cases, depending on the client, when will they pay that payment onto the balance on the visa? And I time that accordingly. So I know it has to be paid by a certain time, but I'll try to see if we can pay it any sooner, like anywhere right in around there, depending on what they're using that credit card for. This is back to, and it depends. I mean, there is some clients that they need inventory and they buy all of their inventory on their credit card. And if you don't pay that by a certain time, now their credit card is maxed and they can't bring in new merchandise and keep their revenue stream going. So there's definitely a lot of, it depends with this. And so, you know, for me, what I do when I'm forecasting it is, what you should make sure you don't do is don't forget about all those things that go into the credit card. So if you've got credit card payments going for things like cell phone bills or anything, utilities, all of those things, there can be so many things that you can put on credit cards now. And man, there's those clients who believe that they just need the points. So they're throwing everything on the credit card. Just don't forget about those. So don't forget that there's still a cell phone bill that's obviously not going to be on that bank statement that you're drawing out, but that it still needs to be paid at some point in time. So it depends on how much is going on that credit card is probably the easiest answer for what I do. Is it a ton of transactions or is it a few things? And if it's a few things, then I put those into my cash forecast based on the timing of when the credit card payment needs to be made. If it's a lot of things, then I'll usually lump those together and say, I know that typically they have this much money that goes onto the credit card each month, especially if it's inventory. I start to know how much merchandise they're going to buy and how much is going to go into the card. So then I build that into the forecast as a lump sum amount.
Yeah, and I think a lot of the it depends is how tight they can go to zero. Because I would tend to think that if you have no line of credit and you can't go below zero, there's no overdraft, there's nothing. Like once you hit zero, the bank is shutting you down.
Yeah.
That probably dictates a lot. And if that's the case, you know, you would go to your method where you're actually almost doing cash flow forecasts for both the bank account and the credit card. And you're literally doing it super granular for both of those. And then you're also doing the transfers between the two. And that will give you the most accurate forecast on the planet. The problem is that it's going to take a lot of time to do that. Which then goes back to, can you actually charge for that, right? Because you're talking about a very manual, intensive process. And it's probably for a client that probably won't be able to charge full rates for that. Maybe. Yeah. It depends.
It depends, but I think at the end of the day,
it's like our new catchphrase.
It determines, or it depends on how much is that worth that time, or can you use a lump sum amount that's still going to get you accurate enough information that you can still make decisions off of it, advise off of it, determine when AP payments are made, etc. So don't kill yourself over this when the client's not going to pay you for that granularity. And if I'm the client on the other end, I don't know if I'm going to pay you for that anyways, because if you can still make decisions off of less granular data that doesn't take you as long, then I'm probably more likely to say, just go with that method as long as I can still get the accuracy. So.
And I think that's a super valid point. I mean, I've actually done a forecast for one of our clients where they pull in anywhere from $200,000 to $600,000 in revenue per month. And I actually considered that as one charge on one day every single month. And it was good enough. It was good enough for mapping out that client situation and allowing us to make decisions on their cash management side, as well as some capital planning, because they needed to buy some equipment and tools and this, that, the other. And so it gave us enough information to make those decisions.
Okay, two other questions here. The one we can answer super quick because unfortunately I don't want to get into pricing yet. That said, if you have questions about pricing that you want to talk about, this one question is about how to price to provide monthly cash flow. We are going to, in either November or December, we're planning on doing, this topic is going to be all about pricing and selling this as a service. So I don't want to dive into that now, but if you've got questions about that before that transpires, shoot us a note. And then the last question, as we got 1 minute to go, government grants and subsidies. I would treat this as, when do you anticipate that money coming in? I'm assuming that's the question, is how to cash flow forecast for that. And I would say using best estimate, when do you expect that to come into the account? Because that'll be a lump sum that gets dropped into the bank, and use a very conservative approach to that, because we all know that sometimes those things could take longer than you expect. But I would use it the same as anything else that's going to get dropped into the account. Great example of this that I deal with clients is income tax credits, so GST credits for leasehold build outs, that we don't actually know the timing of that, because CRA can take their time on giving you that money back. So I'm very, very conservative on when I expect that money to come in, and basically hinge some other decisions off that. So a government grant would be a great example of like, be conservative when it's come in, and make sure then that you're triggering things off of that now will be paid only once that money comes in.
Yeah. It's probably the biggest and best highlight, I think, of the whole, what we've talked about, is try to be as conservative as you possibly can. I mean, if you're too conservative, it then creates operational inefficiencies, and your client's going to get upset because you're essentially holding back too much. But the reality is that you're dealing with a lot of estimates here. It is what it is. Like, you're not going to get around that. There's going to be estimates somewhere in your cash flow forecast. And so the reality is because you're having estimates, you need to have a little bit of conservatism in there so that you've created your own buffer. And so, hopefully you're getting to a point where your client's in a conservative mode while still growing. I mean, it's totally possible. And then you've always got this upside. And so it's just part of your process.
Yep, for sure. Okay, we are out of time, and it is Friday. I'm not keeping you here any longer. If you guys have any feedback or any additional questions, please reach out to us. We will be continuing these at least for a few more months, and then kind of going from there as to what we've got for topics for 2020. But if there's anything that you have for questions, please let us know. You will get a recording of this afterwards. If you're somebody who wants Canadian CPD credit and you didn't let us know when you signed up, please do shoot me a note, because I tweaked that partway through this process. So that will be available for you. I'll be sure to get those certificates out here in the next few weeks. But I hope you all have a great weekend, and thank you for joining us.
Yeah, thank you.
And we'll see you next time.
See ya.
Bye.